Brad Williams, Frugal Finance, series of cash flows. In simpler terms, when you have a bunch of money coming in or going out at different times, like getting paid or paying bills, you can figure out how much it's worth today or in the future. Let's say you have 400 coming in a year, 300 in 2 years. If you want to know how much all that money is worth today, you add up the value of each amount after discounting it back to today's dollar. Similarly, if you want to know how much all that money will be worth in the future, you add up the future value of each amount after accounting for interest. So we have a present value and a future value example coming up. For example, if you have $300 coming in next year, you calculate its future value by multiplying it by 1 plus the interest rate. Then, if you have $200 coming in 2 years, you multiply it by 1 plus the interest rate to whatever term that is. That looks like in 2 years, and so on each month. Alternatively, you can use a formula to calculate these values more efficiently, especially when dealing with many cash flows. This formula lets you plug in the interest rate, the time each amount is received or paid, and the amount itself to find out the total value today or in the future. For your specific scenario, you have $300 coming in next year, $300 going out in 3 years, $200 coming in 4 years, and so on, and you will want to find out how much it's all worth today or in the future. You can use this formula to get your answer. Here we have this intimidating looking formula. It's not that bad. P, present value, equals A, annuity, or the amount you're putting in. And then 1 plus, and then keep in mind this negative, plus A, because we're using this P function, present value. And there's your summation. We're just going to continue this. We have the summation here. This is just this right here. Or equivalently, this, which is the engineers. Consider the series of cash flows shown below. Using an interest rate of 6% interest period, the present value equivalent is given by 300 times 1 plus the term, which is 6%, and the period. So you want to make sure you use the caret and then the negative sign. Then that's money coming in. Then money going out, you want to subtract it. That's in period 3. Then we have 200 coming in at year 4, and then another 400 coming in at period 6, 200 coming in at period 8. There it is. There's your number, 597.02. The future value equivalent is equal to the sum of the future value equivalents for the individual cash flows. In this particular situation, we're going to use this F, then we're going to have A, then we're going to use the same format, except for we're not going to be using the negatives. You got to get rid of the negatives. So we're going to follow the same format. Here, we're going to use this particular layout right here. And then here's the formula. What's the future value at period 8? We're going to take this 300 and notice what we're doing here. Notice the layout. And I'm going to allow you to work through this a little bit on your own. We have 300, but it's at period 7, 305, 200 at 4, and then in the end, we have 200. Notice, just keep in mind, everything's backwards here. Now, instead of this being period 1, we're using this as period 7, and then the future value is going to be 951.56. I know, it's kind of screwy logic, but think through it. Try to understand why it's laid out this way. Future value. Present value, future value. Brad Williams, Frugal Finance. See you soon.